Hey, what's up guys? Houston back in video number 2. Now, in this video, I want to ask you, do you know if your business structure is stopping you from getting funding? No, what I'm going to explain to you is that your business structure can stop you from getting funding. The state that you actually set your business up in can stop you from getting funding. Also, whether you should use a H corporation or a chef corporation, all right? So let's just dive into it. First of all, talking about the business structure, all right? Most people look at LLCs, S Corp, right? They have C Corp, and they have DBAs, right? So those are your structures for your businesses, right? Here's the thing about it that most people don't understand. A lot of lenders, if you have this DBA doing business as, a lot of lenders now, they're passing you up in terms of funding, making it a little more challenging. Not saying it's impossible, but they are making it a little more challenging for this, okay? So what they're doing, people would say, well, let me go to an attorney or a CPA. So what ends up happening, most of the time when you go to an attorney or a CPA, what they would do, they would set you up with an LLC. Now, there's a specific reason why they're doing this, and it may not be to your benefit, especially when it comes to funding. The number one reason they do this, so that you can avoid taxes, right? So you can avoid taxes. So you may be working a job, you may be doing something else or whatever. And so they said, well, I want to start a business. So they said, what's the main goal? And they're like, are you worried about taxes? Most people, yeah, I'm worried about taxes. So they'll choose this. Even if you look at your accountants and CPAs and stuff, a lot of them, they use LLCs. But the challenge with LLCs that most people are not aware of is they're not considered growth company, especially as one owners. All right. So that's one of the things. Now, let's talk about this S Corp, right? So people figure, well, I'll just be an S Corp. So in terms of like pass-throughs to where they can act like a C corporation or whatever. But here's the thing about it. With S Corps, when you get to a certain level of employees and stuff, you have to turn into a C Corp anyway, right? So this here being a pass-through. Now, the challenge with these here two pass-through is that the revenue that's coming in, and please understand that I am not a IRS agent, I am not a CPA, I'm just going off the facts from what I've been doing in this industry over 2 decades so that you can clearly understand my perspective that you can take into consideration, okay? So what ends up happening, people have LLCs. Now the revenue that comes into the LLCs, it has to be directly dispersed to everybody, right? And so because it's directly dispersed to everybody, then that means that your AGI, your adjusted gross income can increase, right? So that means you're going to end up paying taxes, higher taxes anyway. Now, another thing that they don't tell you, if you over expense with your LLC, what can also happen, like when you do over mileage, certain write-offs and stuff with your LLC, this can also trigger a audit, all right? And most of the time with your pass-through companies and your DBAs, you're going to get the newbies that are not aware of tax write-offs and stuff like that. But one of the things I always tell people when you're talking about using an LLC and things of that nature, just keep in mind to be very cautious of the expense aspect of it, all right? And because of this, somebody correct me if I'm wrong, it's fringe benefits, right? So with your fringe benefits, you can't put as many fringe benefits under your pass-through as you could with your C corporation, okay? And in terms of your C corporation, because you are actually working directly for the corporation, now a lot of the friends like your 401k, your IRA, dental plan, your health plan, your HSA, and things of that nature, you can put more of those under this. Even in terms of like your expenses, you can increase your expenses on this here. Now, another thing that people are not aware is that, like, if you take a loss in your C corporation, then you are able to qualify for a refund. That's the only entity that's able to do that. You can't do that with this here LLC. Okay, you just take a loss. So you may take a loss under the business, but people do it so they can get the tax deduction or the tax rebate under the personal credit. Okay, so that's the reason that they do it like that. But one of the things that makes it challenging for people in the wrong structure when they're getting funding, because most of the people, and I'm talking about a high number of people, 80% of people, they file a loss. So they can't pay any taxes, right? But when you do that with your business, now with financial institutions, it makes it even more challenging for them to actually give you the funding that you need because you're showing a loss in the business. So say that you have profitability in the business, but you have bad credit, you would still be able to get funding with your LLC. But since you had a loss and you have bad credit, now it makes it more challenging, okay? So that's the thing about it in terms of choosing the right structure in terms of funding. Now, let's talk about choosing the right state, all right? So what happens is most people figure that, hey, I'll set my entity up in another state. Like I'm in California, right? And I figure that, well, I'll pay less taxes if I set my company up in Nevada, right? Delaware, or let's see. We have Wyoming, right? Wyoming, you have South Dakota. So we figure that if we set our business up in one of these states, that we won't be identified, as well as we don't have to pay state taxes. But since I'm in California as a foreign entity, now I have to pay for this registered agent, plus I have to pay a foreign entity fee for the state that I'm in as well, right? Now, it gets even better because now if a liability in your company happens, right? And I'm in California. So what could end up happening, that liability, I'm operating in California, but my business registered in another state, the state that the liability is created in, that state laws could supersede and end up piercing the veil as well, okay? And so you still can be sued. That's right. And so you can be penalized as well, because even though these states may not charge for state taxes and stuff, you still have to file for the registered agent and stuff like that anyway. If you don't, again, you can be penalized. So these are things that people are not explaining in terms of when they're going to these states and stuff. That's the reason I tell people that the best state, when you're trying to get the maximum amount of funding, the least resistance from financial institutions, you always want to set up the business in the state that you actually reside in and where you're actually doing business at, okay? Even if it's online, it's better to do business in the state that you're actually residing in. You have better protection, all right? This is so important. A lot of people miss out on this and they get themselves in trouble because they ignore it. Now, also, because of this here, FinCEN, all right? So with FinCEN, basically, this is the IRS police, all right? So now, with new entity as of January of 2024, you have 90 days, okay? You have 90 days to actually report who owns that LLC, that S corporation, that C corporation, okay? You actually have to report that, all right? It's called your BOI, all All right. Now we offer a service to fill the form out, but it's very personal information because they want to know everybody that owns, even if you have kids that own the corporation, you have to provide that information, even their socials. So you have to have socials, driver's license, all of these things to identify who's actually the owners. So if you have partners and stuff, if those partners are deceased and stuff, you have to get documentation saying, hey, this. And speaking of deceased, I'm glad that I mentioned that because this is very important. With the LLC, here's what can happen. When you decease, the LLC has to be dissolved a lot of times, okay? Unless you're actually going to have somebody take it over. All right. Now, there's another thing about it. If you in partnership on their pass-through and that partner may have a liability created, so that liability, and they decide, hey, we're going to take legal action against you, then again, that liability can fall on the whole LLC. So it affects everybody that's involved. Even like when you're getting like personal credit, stuff like that, everybody that's on that pass-through, they pull their credit. All right, they pull their credit. So that's the reason I tell you guys, you have to be careful with this here. All right, so make sure that you also fill this form out. Now, if you had an existing LLC or a LLC corporation or S Corp prior to January 1st of 2024, you have January of 2025 that you actually have to have this form filled out, okay? It's not a long form, and like I tell people, I think it's ridiculous to have people to fill this form out because all of the information is with the Secretary of State. Everybody that owns on the corporation, on the LLC, on the pass-through, like their information is already on there. The only thing that's not on there is your Social Security number, because the only place you will provide your Social Security number is with the EIN, which we're going to be talking about in the next video. All right, but that's something that you want to consider. Now, there's one other thing people want to know: should I use a Chef Corp or Age Corp? Okay. All right. So basically, they're the same. Okay. So basically, these two terms are pretty much the same. But here's the thing about it. If you invest into a Age Corp or Chef Corporation, all right. Now, if they do not keep up with the taxes or the bank statements, this here Chef Corp, Age Corp is no benefit to you. Is no benefit to you, right? So that's the reason it'd be much easier for you to start over fresh, to start from the ground up, because with here, even though you may have a Chef Corporation, because the taxes hasn't been filed, bank statements haven't been kept up, bank account ain't been kept up, no relationship, and it may be an out-of-state Chef Corporate at that, what you end up doing, you're going to have to start that process all the way back over anyway. Now, you also have to still file back taxes on that Chef Corp. And I'll tell you one other thing, to why I would not choose a Chef Corporation over a new corporation is because that Chef Corporation may have an address, right, and they got credit in the past. So now that address has a negative relationship. So when you go to apply for credit and you reactivate that Chef Corporation, you can inherit that debt. It's called phantom debt. So you can end up inheriting that debt, right? So that's the reason I tell people you have to be very careful, because you can reactivate the wrong type of Chef Corporation. Because I have had a client that bought a Chef Corporation, him and the partner, and they end up owing $89,000. $89,000, okay? Now, I mentioned something that's very interesting. that a lot of people got confused, and we're going to talk about it in a future video as well. And this is very important. Which type of address should I use? All right. So just wrapping this up, just keep in mind those steps. Now, again, for those of you that need help structuring your business, you may have questions about the type of business you have and stuff, you can click the link in the description. For those of you that are not for sure about their business structure and stuff, put a comment, send me an email, let me know, hey Houston, can I talk to you about my business structure or whatever? And I'll gladly set up a one-on-one consultation with you as well. So I'll see you in the next video.